The question I'm looking to answer today is, where are the two places you can invest into that you can get a good return on your money? And let me just give you a little hint. It's not the bank. Frank Thomas here, Wealth Generation Strategies. Thank you for joining me today. It's good to be able to talk to you again today. So, the question I opened up with is, what is the best place to invest your money to get good returns? But before I get into that, let me ask you a simpler question first. Why do we even care about getting good returns? And exactly, what is a good return? Might be a silly question, but it is actually a really good question. And believe it or not, most people don't really understand or even ask this question. And it's important to ask and to understand. Investing is all about making money with your money. Let's start with just a standard, old, simple savings bank account. Everybody has one probably. And what happens is you put your money in the bank. Now, they're going to pay you interest on that savings account, and they might pay you 1% interest. Now, what does that mean? What it means is if you've invested $100, after 1 year, the bank will pay you interest of exactly $1, which is 1% of $100. Not very good, eh? But what if you invested that same money into an investment vehicle that paid you 10% in that same year? If you invested that same $100, after 1 year, your investment would be paying you an interest of exactly $10, which is 10% of $100. And it doesn't take a very high IQ to realize that getting $10 and not $1 is the way you want to go. The better return you can get without putting your money at a lot of risk is the way you want to go. But in the intro, I promised you I'll be sharing two main ways that just about anyone can invest into that's easy, and you don't need to be a financial guru to do it. It's perfect for me. I'll just leave it at that because I studied all these financial books in my 30s, 40s, and 50s. And you know something? What did I invest? Nothing. Along the way, I learned a lot of different things about investing and how you can invest that will fit your lifestyle. I don't want to waste tons of time trying to figure out how to trade stocks or how to buy properties that I can invest into and become a landlord. And how do I do that? I went and did all the courses, and it just wasn't for me. I needed simple. And I think I found it. So let's get started. And plus, you're more than likely to see a good, solid 10% return overall if you follow this strategy. Now, it's a two-part strategy, as I mentioned in the intro. And the first part is buying your home. Now, the first place we want to invest money is in the home we live in. A lot of people will say, no, it's not an asset, it's a liability, yada, yada, yada. You know something? Just turn off the radio, because if you're living in an appreciating asset or an appreciating thing or vehicle or whatever it is called a house, then it's going to gain value over time. If you're renting still, it's vitally important that you want to invest into this investment tactic, and you have to look at purchasing a home that you'll live in. But why would you want to buy when you have all the headaches of the down payment? That's the big one. Home repairs, you name it, and the such. You have taxes, you have everything else. Simple. When you decide to sell your home, let's say 5 or more years down the road, you're more than likely to receive back all of what you paid in your mortgage, plus a possible gain in value on that home. Now, a cool side bonus that's not even in my show notes today, just thought about it, is if you're renting, you have no control or very little control over what your rent's going to be next year. When you sign a mortgage, and especially when you sign a 5-year fixed mortgage, let's say, what's going to happen is that payment stays exactly the same for 5 years. And the idea is, after you've been paying that house down for 5 years, and you re-sign, even if the mortgage rate goes up, and it has in my situation, it went from 1.8 and I'm now paying 4.3. So it went up sizably. But because enough was paid off in the home, if I re-sign that mortgage, I'm paying pretty close to the same, or maybe $100, $150 more. So I have a lot more control over how much my cost of living is going to be year after year after year. But the whole idea here is we want to get a possible gain on that home in the long run. If you're renting in that same period, your landlord isn't going to give you back 1 red cent from all the rent you paid. As I mentioned, the rent's going to go up over time, and furthermore, he's more than likely to keep your damage deposit when you decide to leave. Now, the great thing about this is if you can get yourself into a home that's close to your previous rent costs, it literally becomes a forced savings plan. When I sold my previous home about 5 years ago, let me tell you how it all shook out to give you an example here. But before I give you this example, if you're enjoying this video so far, give it a like. This tells me that you're really enjoying this content and you want to see more on this topic. Also, if you want to see more videos from this guy right here, be sure to subscribe. I really appreciate it and I thank you way ahead of time. But let's continue on here. Let's get into this example. I owned a home for 18 years and paid $197,000 for the home. Now, I was foolish. I put a HELOC on a home by listening to bad financial advice, and I never paid down the principal amount of the loan over those years. But let's say I did. Let's just say I did. And these are real numbers here. If I had, I would have had a balance of roughly $90,000 of the principal remaining. Thus, I would receive back all the difference of the original purchase price of $197,000 minus the $90,000, or $107,000. And again, this is that 18 years. It's not 5 years. It's the 18 years I actually held on to the house. But we're not done yet. In that same 18-year period, the value of my home went up, and we were able to sell that home for $433,000. Considering selling costs, let's say I received $400,000. You got to pay your realtor, you got to pay taxes, you got to pay the lawyers, you got to pay movers. You get what I'm getting at here. So let's say I received $400,000 in cash from that home when everything was said and done. Now, from that $400,000, considering I paid the first initial $197,000, I would only really have a net gain in value increase on that 18 years of $203,000, which is the $400,000 minus $197,000. I just want to keep you apprised. Now, if we take that $203,000 of the gain in value plus the $107,000 that we got in returned equity we paid into the home, that would be a great payday of $310,000. Now, if I had rented that same house in that same 18-year period, I would have received exactly nothing, zero, upon vacating the home I had rented. And in all honesty, I've learned better ways to make this plan work better, faster, stronger, and I'm in the process of cashing out again on a house that I've only been in for 5 years and not 18 years. And I'm going to be cashing out at close to the same amount. But this strategy can be done by anyone. It all comes down to getting a down payment and getting the ball rolling. So that's what you want to do. You want to find a way that you can own your own home. Second part of this strategy, investing into the stock market. Now, there's lots of rumor and speculation about the stock market, but we're not interested in this. Yes, it does exist, and the sky is falling, and the prices are going up, the prices are going down. We don't care. We're going to be investing as passive investors. We're going to be doing something called dollar cost averaging over the long haul, over 5 years. And I promise you, if you invest into good companies or good investment vehicles in the market, you will make your money. The simplest way that I can share is looking to invest into stock market products like index funds or exchange traded funds, or their short form is ETFs. You're probably hearing a lot on the internet if you've been looking at financial stuff about ETFs. Now, both of these are slightly different, but they both are baskets of stocks from different market sectors. It could be from healthcare, it could be from banking, it could be from tech. The ones I really love are when they get stocks from the S&P 500 or the NASDAQ. Now, the nice thing about this is diversification, because the S&P 500 will have a bit of stocks from all 500 of those companies that are on the S&P 500 currently. So why do we care about diversification? There is no way we can accurately guess the stock gain or loss over 20 years, and sometimes stocks become worthless. Sometimes stocks go up. I watched a fast forward over the last, since 1980 to 2025, on the top 10 stocks in the S&P 500, and they look completely different over and over again over those years. So we don't want to care about that. We don't want to become stock picking gurus. We just want to invest into a good vehicle that's going to give us a solid return and give us this diversification that we're looking for. Investing into a vehicle that tracks the top 500 stocks in the USA will make it super easy to invest. What we want to do is ideally slice out 10 to 20% of our gross income. Now, it could be a little tough in the beginning, but this is what we want to do, and put it into this investment every time you get paid. This is called paying yourself first, and it's dollar cost averaging into the marketplace. So some days you're going to buy high, and some days you're going to buy low, but at the end of the day, you do not care. Average returns, not considering inflation, are roughly 10%, but if the company that's managing the ETF does some extra tactics, you can possibly see 14% or more. My average return right now is about 16%. But for simplicity's sake, let's say we're going to just invest $700 per month. That is considering the fact that we're making about $85,000 a year. And we put it into the ETF that's paying a solid 10% in returns between the gain in value and dividends. So we have to look at both of those factors. What would that be worth in 10 years, 20 years, 30 years if we kept this plan going? Well, in the first 10 years, your investment would be worth just over $143,000. In 20 years, your investment increases to just over $500,000 at $531,000. And finally, your investment will literally soar to $1.5 million plus. That is nothing to sneeze at. Now, I've got a bonus here for you, and this is what really puts things on supercharged. Because do you want to wait 30 years? I don't have time to wait 30 years. I'm 62 this year. And if I have to wait 30 years, I'm going to be dead. So I'm on fast forward, baby. I'm on fast forward. Remember when I said we bought and sold houses along the way? Let's say you were able to cash out every 5 years by buying and selling a new house, and you cash out with about $50,000 in your jeans by the time everything is settled. And it's not that hard to do. So what would things look like in that same 30-year period? You would probably receive at least twice as much than that, let's say, when you sell the house. But let's just keep it worst case scenario. And we have to consider we need a new down payment for the next house, as well as your moving costs, lawyers, real estate fees, etc. Let's say you took the profit and just invested it once every 5 years. So what's happening is you're still putting your $700 every month in, but every 5 years, you're going to plunk another $50,000 into your stock investment account. Now, how is that going to pan out in 30 years if you did that? In the first 5 years, the investment account would have a balance of about $54,205. If you added that $50,000 into the account, it would immediately balloon to $104,205, and you would start and you would continue investing into the second 5-year period with that amount. We would continue doing this once every 5 years for, let's say, the next 25 years, for a total of 30 years. In 30 years, we'd be sitting at a balance of roughly $1.2 million. Yes, at that point you can decide, hey, I'm gonna just buy the mortgage out when it finishes because I like the house I'm in. And now you're living rent and mortgage free, and you still probably will have at least a $1 to $1.5 million sitting in that account. So it's nice to kind of speculate and pie in the sky and think, does this actually work? Come on, Frank, does it really work? It does. I've been able to save close to $400,000 in just 5 years using these two strategies together, plus a few other strategies I do teach in other videos. So if you subscribed, be sure you do. You want to watch them. But let's say you're not able to save that $700 a month from your salary and you want to learn how. Be sure to check out the video that's showing up on the screen now or in a short moment from now. I'm sure you're going to love it. It contains 4 strategies I've personally employed for years to help me get to that $400,000. What I'm saying is I think you can get to your financial goals way faster than 30 years. My goal is to be done in 8 years. You heard it, 8 years. Thank you so much for joining me today, and I look forward to being able to talk to you again in the future, and have yourself a wonderful day. If you're not sure what I went through here, listen to the video again. It's not a hard thing to do. I'll be sure to add more content in terms of what you can do in these strategies more specifically, but I just wanted to cover the overall strategy. Thank you so much. We'll talk again. This is Frank Thomas signing up for today.